Hey y'all, Jen Hernandez, Loan with Jen. How do you buy a house as a 1099 employee? So we will be right back with those details. Hey, we're back. Be sure to like, share, and subscribe. My channel releases 2 videos per week about home buying tips and education to help you on your next home purchase. Okay, how to buy a house when you're a 1099 employee. So I'm going to go over a couple of rules first and a couple of definitions, and then we're going to get right into it. So when you're 1099, the 1099 is a form that's received by an employer when you're contract. You're not an employee. Let's just say it's XYZ company that you work for doing whatever it is that you do. You sell something, let's just say. You're selling a gadget, and they pay you on a 1099. They don't take taxes out. They pay you either cash, or they pay you with just a handwritten check, or a generated check, but no taxes are taken out. So that signifies a 1099 employee, okay? 1099 again is the form, the IRS form that they'll give you at the end of the year so that you can use that to claim your taxes. So in this instance, you're kind of on your own. You're almost like a business owner. You have the ability to deduct expenses. So you're not an employee of a company that's paying the expenses for you. These gadgets that you sell, for example, working for XYZ Corporation, you have gas and mileage, you might have carry cost, you might have inventory cost, you might have depreciation, you have all kinds of things, meals and entertainment to entertain your customers, whatever, supplies, cost of labor, you might have to contract other people to do something for you. So almost all 1099 employees that we've seen, most of them, at the end of the year when they're reconciling their taxes every year in April, they will deduct on a schedule. It's called Schedule C. It's the Schedule C of the tax return. They will deduct expenses. So let's say that someone on their 1099 from XYZ Corporation made $50,000. The $50,000 was then deducted by a bunch of little expenses. And after all those little expenses, they claimed to the government that they made $25,000. So in that case, when you're going to get a loan, for example, with a mortgage company, we are going to look at that Schedule C, and we're going to see that you made $25,000. That is the income that we will use for calculation of your income. Now, as a side note, there are a few things that we can add back on top of the $25,000. You might have had depreciation. Depreciation is a non-cash expense. It's just a line item deduction that people take on equipment and things like that. So if you had some depreciation, we could add that back in. Let's say that depreciation for this person that we could see on their Schedule C was $5,000. Now their income that we're using isn't $25,000, it's $30,000. We took the depreciation and we added it back on top of the $25,000. So let's say you have $30,000 now. Let's say you had mileage. If you had driven miles, and it's there on your tax return on a certain field, miles driven. So we can give back into the income 25 cents per mile for miles driven. Let's say you had 10,000 business miles times 25 cents, that's $2,500 that we can add back into your income. Now those are really the only 2 expenses for the most part that we're able to add back into the income. So you have to be really careful. Make sure you get with a mortgage professional as soon as possible to analyze your income. And again, we take 2 years of income and we have to average. So make sure you get, again, pre-qualified with a lender. Usually we recommend 6 months out, prior to purchasing a house. You have plenty of time to, make any kind of arrangements that you need to make for qualification. Good luck with your home search. If you're in Texas, call us. Talk to you soon. Legacy Mutual Mortgage is an equal housing opportunity lender. The opinions expressed here do not reflect those of Legacy Mutual Mortgage.